In 2014, two friends started investing at almost the exact same time. Both were 28 years old, both had stable jobs, and both decided they were finally serious about building long-term wealth. Each one started with $50,000 and promised themselves they would leave the money invested for at least the next decade. On the surface, their goals looked identical, but the way they approached investing could not have been more different. The first friend believed successful investing required constant effort. He spent hours every week researching individual companies, watching financial news, reading analyst reports, and trying to identify the next big winner before everyone else noticed it. He built a portfolio of more than 30 stocks across multiple sectors because he thought that was what intelligent diversification looked like. He owned bank stocks, dividend stocks, pharmaceutical companies, energy companies, small-cap growth names, and a handful of technology stocks he felt confident would dominate the future. Every market dip triggered new research. Every earnings season created new decisions. Every economic headline made him rethink the portfolio. The second friend approached investing very differently. Instead of trying to outsmart the market, he focused on simplicity. He bought just two ETFs, set up automatic monthly contributions, and then mostly ignored everything else. He didn't spend weekends studying charts. He didn't check his portfolio every morning. He didn't try to predict recessions, interest rates, elections, or market crashes. His strategy was almost boring compared to the first investor. But 10 years later, something surprising happened. The first friend, despite all his research and constant activity, had grown his portfolio to roughly $190,000. Respectable result by almost any normal standard. But the second friend's simple 2 ETF portfolio had grown to well over $330,000 over the exact same time period, more than $140,000 ahead, while doing dramatically less work. And that difference wasn't luck. It wasn't timing. It wasn't some secret strategy hidden behind complex financial language. It came down to a principle that most investors completely underestimate. Simplicity often outperforms complexity because simplicity is easier to stick with during periods when emotions become dangerous. That's what this video is really about. Not just to ETFs, but understanding why simple systems consistently outperform complicated ones in long-term investing. Because most people don't fail in the stock market because they lack intelligence. They fail because they constantly interrupt compounding with emotional decisions. The average investor enters the market with good intentions. They want diversification. They want safety. They want growth. They want passive income. And because financial content online constantly pushes the idea that more complexity equals more sophistication, investors slowly begin collecting investments instead of building an actual strategy. They buy an S&P 500 ETF because everyone recommends it. Then they add a dividend ETF because they heard passive income is important. Then they buy a few individual technology stocks because artificial intelligence is exploding. Then maybe a clean energy ETF because they don't want to miss the future. Then international funds because someone online said the US market might underperform next decade. A year later, they look at the portfolio and realize they own 20 different positions that all overlap in confusing ways. The result isn't true diversification, it's financial clutter. Many investors don't realize that owning more investments does not automatically reduce risk. In many cases, it simply dilutes returns while making the portfolio psychologically harder to manage. Imagine owning 5 different large-cap ETFs that all heavily weight the same companies like Apple, Microsoft, Nvidia, Amazon, and Meta. It feels diversified because there are multiple tickers involved, but underneath the surface, you still mostly own the same businesses repeatedly. Complexity creates more moving parts, and more moving parts create more opportunities for emotional mistakes. Research from Dalbar has consistently shown that average investor returns significantly trail the actual returns of the funds they own. Not because the funds are bad, but because investors panic during downturns, chase trends after they already surged. or abandoned strategies during temporary underperformance. The issue usually isn't investment quality. The issue is investor behavior. Every additional position creates another thing to worrying about during market volatility, another chart to monitor, another headline to react to, another opportunity to second-guess the plan. This is why simplicity matters far more than most people realize. A simple portfolio is easier to understand, easier to manage, and much easier to hold through market crashes without panicking. And in long-term investing, behavior is often more important than intelligence. That brings us to the first ETF in this strategy, VOO. This is the foundation of the portfolio. VOO tracks the S&P 500, which contains approximately 500 of the largest publicly traded companies in the United States. But what makes the S&P 500 so powerful isn't just the companies currently inside it. It's the way the index evolves automatically over time. Weak companies gradually lose importance or disappear entirely, while stronger companies rise naturally to the top. 20 years ago, companies like ExxonMobil and General Electric dominated market leadership. Today, companies like Apple, Microsoft, Nvidia, Amazon, and Meta occupy those positions. The index continuously adapts to changing economic realities without investors needing to predict which businesses will dominate the future. That automatic adaptation is one of the greatest advantages of broad market index investing. Instead of trying to identify tomorrow's winners ahead of time, investors simply own the system that naturally shifts toward successful companies over time. VOO frequently provides exposure to businesses across technology, healthcare, financial services, consumer goods, industrials, energy, and communication sectors all inside one single ETF. Technology currently represents the largest sector weighting because technology companies have become some of the most profitable and influential businesses in the global economy. But if leadership changes over the next 20 years, the index will gradually reflect those changes automatically. That's an incredibly important concept because it removes the need to constantly predict the future. The investor doesn't need to know which specific company dominates artificial intelligence in 2035. They simply need to own the index that will eventually weight the winners more heavily over time. Another reason VOO is so attractive is cost efficiency. The expense ratio is only around 0.03%, which means investors pay roughly $3 annually for every $10,000 invested. That cost is almost invisible compared to actively managed mutual funds charging 1% or even higher fees. Many investors underestimate how destructive fees become over long periods of time. A portfolio paying an extra 1% annually may not sound significant in a single year, but over decades, that seemingly small difference compounds into hundreds of thousands of dollars in lost wealth. The lower the cost structure, the more of the market's actual return stays inside the investor's account instead of going to fund managers. Warren Buffett has repeatedly argued that low-cost S&P 500 index funds are one of the best long-term investments for the majority of investors, precisely because they remove unnecessary complexity and minimize fees. Historically, the S&P 500 has produced strong long-term returns despite recessions, wars, inflation periods, financial crises, and political uncertainty. Over long enough time periods, the market has consistently recovered because the underlying businesses continue innovating, generating profits, and expanding economic productivity. That doesn't mean the journey is smooth. There will absolutely be painful downturns. In 2008, markets collapsed during the financial crisis. In 2020, the pandemic triggered one of the fastest crashes in modern history. In 2022, rising interest rates caused sharp declines across growth stocks and major indexes, but each time, markets eventually recovered and moved to new highs because successful businesses adapted and continued growing. That resilience is what makes the S&P 500 such a powerful long-term wealth-building tool. but while VU provides stability and broad exposure. The second ETF in this strategy exists for a different reason entirely. QQQ acts as the growth engine. QQQ tracks the Nasdaq 100, which focuses heavily on large-cap growth companies, particularly in technology and innovation-driven industries, unlike the S&P 500, which spreads exposure more broadly across sectors. QQQ intentionally concentrates more weight into companies driving technological transformation. Its top holdings include names like Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Tesla, and Alphabet. These companies dominate industries tied to artificial intelligence, cloud computing, semiconductors, digital advertising, software infrastructure, and e-commerce. Over the last decade, many of these businesses generated extraordinary revenue growth and profitability, which translated into massive shareholder returns. That growth is reflected clearly in QQQ's long-term performance. Over certain 10-year periods, QQQ produced annualized returns exceeding 20%, dramatically outperforming broader market indexes. A portfolio compounding at those levels grows astonishingly fast over time. Money doubles much faster when annual returns increase even modestly. That's one of the reasons growth investing can become so powerful over long periods. However, higher returns always come with trade-offs, and QQQ's trade-off is volatility. Growth-focused funds experience much larger swings during periods of economic uncertainty or rising interest rates. In 2022, QQQ experienced a brutal decline as investors rapidly repriced technology valuations amid aggressive Federal Reserve rate hikes. Many investors discovered during that period that they were not nearly as comfortable with volatility as they thought during bull markets. This is one of the most important psychological realities in investing. Everyone loves aggressive growth when markets are climbing. The real test happens when portfolios fall 25%, 30%, or even more, and investors must decide whether they truly believe in their strategy enough to continue holding and buying during fear. This is where combining VOO and QQQ becomes interesting. The two ETFs complement each other surprisingly well. VOO provides broad diversification, exposure to the overall American economy, and somewhat lower volatility. QQQ provides concentrated exposure to high-growth businesses with greater upside potential. Together, they create a portfolio that balances stability and aggressive growth simultaneously. A 50-50 split between VOO and QQQ creates a portfolio tilted heavily toward innovation while still maintaining broad market diversification. Investors seeking slightly lower volatility might prefer a 60-40 allocation favoring VOO. Either approach can work. The specific percentages matter far less than the investor's ability to consistently stick with the strategy during difficult market environments, because the truth is that no portfolio succeeds if the investor abandons it during crashes. The biggest advantage of a simple 2 ETF strategy is not just performance, it's psychological durability. When investors own dozens of individual positions, every earnings report feels stressful, every news headline feels threatening, every correction creates uncertainty about which holdings might collapse permanently. But when the portfolio consists of 2 broad, high-quality ETFs, the decision-making process becomes dramatically simpler. Instead of worrying about individual companies failing, investors focus on continuing to own broad collections of successful businesses through different economic cycles. Simplicity reduces emotional noise, and reducing emotional noise is one of the most underrated advantages in long-term investing. There's another important concept many investors overlook: time horizon. People dramatically underestimate how powerful compounding becomes over multiple decades. In the early years, progress feels slow. A portfolio might grow from $10,000 to $15,000 and not feel life-changing, but compounding accelerates as balances become larger. Eventually, annual market gains alone can exceed entire yearly salary contributions. That's when wealth starts snowballing. For example, someone investing $500 monthly into a portfolio averaging 12% annual returns could end up with roughly $1.70 million after 30 years. Increase the average return modestly to 14%, and the ending balance climbs dramatically higher. Small differences in return percentages create enormous differences over long time periods because compounding magnifies everything. That's why the combination of strong long-term assets and consistency matters so much. Investors often search endlessly for perfect timing opportunities while ignoring the fact that regular contributions into excellent assets over decades historically created extraordinary wealth without requiring prediction. The key variable is usually not intelligence, it's behavior. Can the investor continue buying during crashes? Can they resist panic selling during recessions? Can they avoid constantly changing strategies every time markets become uncomfortable? This is exactly where most investors sabotage themselves. They start with a reasonable plan. Then markets decline sharply. Financial media becomes overwhelmingly negative, and suddenly investors convince themselves they need a completely different approach. Maybe they shift into cash because a recession feels imminent. Maybe they sell growth investments after large declines because they fear further losses. Maybe they abandon index funds entirely to chase whatever sector recently outperformed. The problem is that emotional investing decisions usually occur at the worst possible moments. Investors often sell after markets already declined significantly and then hesitate to reinvest during recoveries because fear still dominates headlines. Over time, these behavioral mistakes quietly destroy compounding. Missing only a handful of the market's strongest recovery days can dramatically reduce long-term returns. That's why consistent participation matters more than perfect timing. The investors who build meaningful wealth are rarely the people constantly making dramatic portfolio changes. More often, they are the people who selected a logical strategy early, automated contributions, and allowed time to do most of the work. Another advantage of ETFs like VU and QQQ is tax efficiency. Broad index ETFs tend to generate fewer taxable events compared to actively managed funds with frequent turnover. Additionally, many dividends from large cap U.S. companies qualify for favorable tax treatment under current law. Over decades, these tax efficiencies can meaningfully improve after-tax returns, especially inside taxable brokerage accounts. Investors often focus entirely on pre-tax returns while ignoring how taxes quietly reduce compounding over long periods. Minimizing unnecessary trading and turnover helps preserve more capital inside the portfolio where it can continue growing. Again, simplicity creates hidden advantages that many investors overlook initially. Now, it's important to remain realistic. The past decade was unusually strong for large-cap U.S. technology companies. Future returns may not match recent historical averages exactly. Markets move in cycles, and there will absolutely be periods where growth stocks underperform broader indexes, or where international markets outperform the United States temporarily. That's normal. Long-term investing is not about finding an asset that outperforms every single year. It's about owning strong assets through many different economic environments while maintaining discipline. Even using more conservative assumptions, the long-term math remains incredibly powerful. A portfolio averaging 10% to 12% annually over multiple decades still creates enormous wealth for consistent investors. The biggest mistake people make is underestimating how meaningful those returns become over time. Investors often chase unrealistic overnight gains while ignoring the fact that steady double-digit compounding sustained over decades historically produced financial independence for millions of people. And perhaps the most important lesson in all of this is that successful investing usually feels boring while it's happening. Social media celebrates dramatic trades, overnight gains, and speculative baits, but real wealth creation often looks repetitive and uneventful. Monthly contributions, consistent investing, ignoring short-term noise, holding quality assets through uncertainty, staying patient while compounding slowly accelerates in the background. The investors who become wealthy are rarely the ones constantly searching for excitement. More often, they are the people who understood a simple strategy deeply enough to trust it during periods when emotions tempted everyone else to abandon theirs. That's the hidden strength of the 2 ETF portfolio. It removes unnecessary complexity while still providing exposure to some of the strongest businesses and most powerful growth trends in the world. It simplifies decision-making, reduces emotional mistakes, minimizes fees, and allows investors to focus on the only variable they truly control: consistency. At the end of the day, building wealth through investing is not about predicting every market movement correctly. It's not about finding secret stocks nobody else knows about. And it's definitely not about constantly proving how smart you are through complex portfolio construction. Most long-term wealth is built through patience, discipline, and time. The market rewards ownership far more consistently than prediction. And sometimes the smartest strategy is not the most complicated one. Sometimes the smartest strategy is simply choosing excellent assets, automating contributions, and giving compounding enough years to completely transform the outcome.